Hello everyone, welcome back for another episode of Market Bites. I'm joined by our favourite market analyst, usually based in Sydney, Australia, Josh Gilbert, but you're not today.
No. I'm adventuring around the world. I'm in Singapore at the moment, so an exciting time. We've got an office here in Singapore, so doing a few things on the ground here locally. So yeah, fun to be here. It's very humid, not very nice in terms of that. So just coming to terms with that, but it's a beautiful city and yeah, exciting.
I do think we have a few people that listen from Singapore, certainly that join webinars from Singapore. So I imagine they will completely agree with the humidity. Talking of subjects, we're going to do CPI, which came out yesterday, and ultimately, spoiler alert, it's unlikely to derail that September cut. We'll also discuss the RBA as well, who had their meeting earlier this week, and then we'll look at some companies that are really underperforming the S&P 500 near 52-week lows and ask if there a value opportunity there and that kind of thing. Josh, that sound all right?
Yeah, it sounds good to me. Yeah, busy old time in markets, as per usual. We're kind of still sort of dealing with some of that tariff fallout, inflation numbers coming through, question marks over US economy, Chinese earnings sort of rolling through. We've got some big names coming up, Tencent, those types of names coming through over the next week as well. But we've still got Donald Trump and Jerome Powell going at it. Sam, you're a man who loves Twitter, so I'm absolutely guessing that you saw his sort of post yesterday about Powell not long after that inflation number.
Well, firstly, you're right. I do love Twitter, and sometimes at work when I'm in the office, because I have X up the whole time, I sometimes forget that people might not think I use it for work, and they just think he's just on X looking for memes the whole day. But for anyone that listens to this that's in the office, I do use it for work. But yeah, the Jerome Powell tweet by Donald Trump yesterday, I'm sure some of you have seen it. But let's go through it now. Jerome, too late Powell must now lower the rate. Steve Mnuchin, spelt wrong in a funny way, really gave me beauty when he pushed this loser. The damage he has done by always being too late is incalculable. Fortunately, the economy is so good that we've blown through Powell and the complacent board. I am, though, considering allowing a major lawsuit against Powell to proceed because of the horrible and grossly incompetent job he has done in managing the construction of the Fed buildings. $3 billion for a job that should have been $50 million fix-up. Not good. With that said, Josh, I mean, it wasn't all just about rates there. He decided to go on another rampage against him about something else at the end. This was in response to the inflation number. What are your thoughts on that?
That is absolute chaos, by the way. Like, who gave like their dad a phone? Do you know what I mean?
Yeah.
Like, what is going on there? Like, surely, he's the president of the United States. Does he not have someone sitting next to him say, Donald, please don't post that. We could kind of do without that at the moment. It's just flying under the radar.
Take his phone away.
Yeah. Anyway, look, no, you sort of said it at the top of the episode, that sort of inflation number probably is not going to do too much in terms of sort of shifting this expectation that we're going to get a cut from the Fed in September. 96% chance when I had a look on Bloomberg today for that cut. And it's coming from two main metrics, right? Obviously that inflation number and employment. And at the moment, both are moving in the wrong direction. And therefore, the Fed are going to need to address that. Inflation, ultimately is the one that we're sort of looking at. And I think that they're going to need to sort of step in. We had a long conversation, on this episode of Market Bites in the past about, whether the Fed will cut, and it's sort of they're data dependent on that. And I think that if we look at the data that we're getting from jobs, and if we're looking at those inflation readings that we're getting, I think it gives them enough room to be able to sort of cut rates. And I don't think anyone's, probably going to argue if they did cut. I mean, I even saw from some commentary from Scott Besant, overnight saying that he thinks that they should cut by 50 basis points. Again, unlikely to happen, but who's to say they don't, right? We had that before, and that was a big surprise to markets. What's that meaning for markets? Well, got markets trading close to all-time highs, and I think it's a bit of a the reaction yesterday that we got from markets was maybe a bit of a relief, a move back into sort of risk-on assets. Crypto doing tremendously well, by the way. Ethereum absolutely rallying up to about 4,600 today. That had been sleeping for a long time, but just broadly in general, crypto assets doing really well. But look, that inflation number, as I say, I think basically just nails on a cut next month. We're obviously going to get some more data. At the end of the week, we've got retail sales coming through from the US on Friday. That will be interesting to sort of see if consumers, appear to be as upbeat as what we're sort of maybe getting from the corporate earnings front, because they've sort of been pretty positive, I think, mainly from what we've had from those sort of retail-facing businesses. And yeah, I think look, the numbers are going to be focused, and investors are going to be focused on what's happening in the labor market, inflation, and retail sales. But ultimately, for me, they're signaling that it's time for the Fed to cut rates.
Yeah, it seems that way, doesn't it? I mean, small caps yesterday had a day, didn't they? The Russell was up, I think 3%. And if there's one thing the Russell and small caps love, it's rate cut expectations going in the right direction for them. And yeah, as you said, 96% chance of that September cut, and there's not really too much in the way of bits, macro data before we get to that point that could massively change that. And I think it's going to happen. That 50 basis point, that Besant one, I mean, that's not going to happen. I don't think the Fed aren't going to do nothing for ages and then suddenly go, you know what, Trump, here's your 50. How about that? And even if they got 50, you can just imagine Trump would say he should have done this ages ago. It's not going to go exactly how it wants, but we got there in the end. Maybe famous last words, and it doesn't happen, but it does feel like everything is set in stone for the Fed to start cutting again, Josh.
Yeah, no, it does. And like you say, kind of Powell is sort of caught between that rock and a hard place, right? Like you say, if he delivered a 50 basis point cut, Trump would, absolutely kill him. And I think that sort of, the tough place that Powell is in at the moment is that it's sort of really questioning the integrity, ultimately. Is that Fed that sort of holy central bank that everyone looks to across the world? It's not a great look for the US in general. When I think that Fed have done a pretty good job. If we think about what Jerome Powell has done, if we look at the US economy, yeah, okay, the jobs market's weakening a little bit. We've seen that inflation's moved in the right direction. There's a lot of people calling for recession, a lot of people, and a sharper slowdown in the economy than we've expected. Got markets set at record highs. I think they can probably give themselves a bit of a pat on the back, to be honest. I'm not an economist, but from a stock market perspective,
I think he's done a good job.
Yeah,
I'm completely with you. And the labour market's slowing. It's not slowed massively. And as you said, recession fears have been here for 2 years now. And Jerome and the Fed have done pretty well. And maybe deep down Trump knows that. But at the same time, his beloved stock market is on the all-time high, and I'm sure he'll be happy about that. On the topic of central banks and rate cuts, the RBA lowered their cash rate yesterday. One of many cuts to come, or not?
Yeah, they did cut. We've been on a bit of an easing cycle in Australia over the last sort of year or so. Paused last month, which was a bit of a surprise. A lot of people had expected them to sort of cut last month, so that was, as I said, a bit of a surprise. But I think it's sort of, the cut that we got yesterday kind of really reflects this sort of confidence that inflation is under control and that the Australian economy does need that little bit of a relief. And it comes from the similar points that we've just sort of mentioned of why the Fed is going to cut: falling inflation, softening demand, and a labour market that is showing signs of loosening. We had Q2 CPI falling into the RBA's target band, the bottom of the band. It was at 2.1% last quarter. Unemployment ticked higher. So that kind of case for a cut had kind of been hard to ignore. As I say, there was question marks as to why they didn't cut in July. So to get a cut this month, it was pretty much nailed on. But they've sort of remained measured. They've sort of reinforced its commitment to, similar to what the Fed have done, being gradual, data dependent, that type of approach. But I think it shows us that they are confident that inflation is under control and that the risk of holding rates too high for too long is outweighing the risk of inflation. So I think that was quite important. Michelle Bullock who's the RBA governor, she was quite keen to sort of stress that it's not going to green light continued easing. We're probably not going to get back-to-back cuts. The market does expect to see another cut from the RBA this year. That's probably going to come as early November. But I think that, as I say, they'll continue to sort of take that cautious stance, won't go too dovish on us. But it is an important turning point, because data has continued to move in the right direction. And although we won't see aggressive easing from the RBA, it just basically means that rates are going to keep gradually coming lower, which is obviously great news for equity markets. ASX is set at record highs, but it's also good news for consumers as well that have had to deal with high rates for a long time.
Yeah, and nothing wrong with that little bit of a pause if you're going to get back on the train, and they did. And the UK had been in a similar situation, but we lowered rates last Thursday, I think it was. Massive split, really, in terms of the reaction to it. I personally don't think the Bank of England should have lowered rates, and it was a 5-4 split from the Monetary Policy Committee. But inflation here isn't under control. And I don't know whether lowering the interest rate was the right thing to have done. So we'll have to wait and see. And ultimately, and I saw Lale, our global market analyst, our strategist, was talking about this as well. As in that situation, there's no harm in actually just waiting to see how things pan out. You don't always have to make a decision. And that's what Jerome Powell's done so well, actually, when you think about it, is the beginning of the year, you've got all these tariff stuff. Okay, let's wait and see what happens. And then also, we're not going to do anything unless the labour market comes under massive pressure. And it didn't. The 3-month rolling average of the non-farm payrolls was solid. It really was for a long time. So, yeah, I don't think patience is a bad thing before then getting back on the rate cut train or whatever it might be. So, fair play, RBA. Bank of England, not good marks from me.
Yeah, and I think you made a good point there about Powell as well, right? I know we've spoken about him a fair bit, but go back to, some point, within the last, let's say, 12 months, I'm pretty sure the markets were pricing in 5 cuts from the Fed this year. So, yeah. To sort of go against that and to sort of sit back and sort of watch, it's been the right decision, clearly, right? Because inflation has gradually moved in the right direction, but it's been slower than anticipated. So if they would have cut rates at the start of the year and, done that quite aggressively, then we might not be sitting in the same position saying that the economy is in a good stead. And, the GDP figures coming in were, recently were pretty solid as well. So we might not be sat in the same place. We might not see markets at sort of record highs. So, it's interesting to see how each bank is sort of slightly different, but kind of maybe also taking the lead off of the Fed at the same time. You mentioned at the top of the episode, Sam, you mentioned record highs, and we mentioned some names that maybe haven't been performing too well this year. Let's look at 52-week lows, shall we? What names are sort of sitting around that 52-week lows? Let's give some contrarian shouts for our listeners.
Yeah, it's an interesting one, isn't it? I mean, you definitely have some investors that are purely looking at this, or multi-year lows, and think, okay, where's the opportunity here? Because I mean, simple maths: if a company drops 50% to go back to its all-time high, it's got to go 100%. So some people see that as a great opportunity. If it's a good company, it's going to recover. I'm going to double my money here. If it's obviously bigger than that, that return goes up, and if it makes new all-time highs, fantastic. And I guess you've seen it with companies like Netflix, when that was down 80%, an incredible recovery. I think similar number, maybe 70-80% as well. And then you have companies like Carvana, which obviously dropped significantly more than that, but then recovered all the way to its all-time high. I think it was trading as low down as like $3.50 and then traded up to 400, which is an incredible return. So some people do really like the idea of these stocks that are beaten down and trying to find that opportunity. However, it is worth saying, for the most part, when a stock is lower, there's a good reason for it, and they're not all going to recover. I think before we look at some names and some that have really underperformed the S&P 500 this year, it's worth, I guess, for anyone listening to this, certainly new to the markets, to sort of ask yourself a few questions. One, the financial health, and you can look at the revenue and earnings and debt and all these things. Are they stable? Are they deteriorating? Are they heading in the wrong direction? Is it just a couple of quarter blips, which is fine? That can happen. And also stocks can absolutely get punished for a bad quarter. You look at the trade desk last Thursday, or might be in Friday before the open, either or, bad earnings quarter, and it drops significantly. You can have a bad quarter that can change things. So have a look at the whole picture. Look at the overall trend of those metrics, or any metrics that are specific for that company. And obviously look at the industry trends as well. When you look at these companies, look at their competitors. Are they also struggling too? Is there a bigger picture at play here? There was a period not too long ago where home builders were really struggling in the US. And then they all started to just bottom out a little bit as rate expectations started to come into play again. And they're significantly off those lows now. They're flying, actually. So sometimes it can just be, that a trend in the market or something cyclical that's affecting these stocks, and they come under pressure. And actually, it's maybe just waiting for a new catalyst to come in for that recovery. And once you get that, then you've got these stocks that are near the lows. But at the same time, if it's a company where everything's going really well for the industry and the trends are heading in the right direction, it's struggling, that's not going to be a good sign. Of course, things can change, though, and maybe that's a question to ask yourself when looking at these companies. What needs to change? Is it a change in management, a change in strategy? When we look at companies like Starbucks, Nike, and Burberry, and all these companies that maybe lost their way, they tried to go and do something different, and it's not until new management came in and took them back to what they were really loved for or known for, where they saw that recovery. Abercrombie and Fitch, for example, they had an insane recovery, didn't they, a few years ago, albeit they're off their highs now. But ask yourself the question, what needs to change? And then until that happens, or there's rumours of that happening, the company may well continue to struggle there. Just having a quick look then, and I actually had this chart up from last week, so there might be a few that are just slightly off, but it's the worst performing stocks in the S&P 500. So you've got Trade Desk, which are now in there. If we had done this 2 weeks ago, they wouldn't have been in there. They just had a really bad quarter, or were judged poorly, should we say. Centene Group, Enphase Energy, Lululemon. We've talked about Lululemon a fair few times on this podcast, and they're currently struggling. I think they're down about 50% in 2025, which is brutal, really. But at the same time, that they could well be one that do recover. And you have to ask yourself what needs to change there. Deckers Outdoor Group, United Health, Dow, Moderna in here as well, GoDaddy, Chipotle. Do you know what? I've never had a Chipotle in my life.
I don't have it in Australia, so I've never had it. So
well, there you go. We both haven't. Maybe we're part of the maybe that's why they're struggling.
Yeah.
So Accenture as well, and there's a few others. But healthcare has obviously struggled a fair bit this year. Underperforming sector. There's a few of those names in there. A few IT services, which maybe shocked me a little bit. And then you've got a bit of like media, like the Trade Desk. But yeah, a lot of healthcare in there. And look, we could do this again in 3 months' time, and there'll be a new sort of industry trend of companies struggling, Josh. But I think ultimately for newer traders, newer investors, it is just a case of having a little bit of patience and actually doing your research if you are looking at these companies, because if they do recover, the reward is great, isn't it?
And I think that's the point. You kind of were listing some of those names there, and there are some quality businesses there. Right?
Yeah.
Deckers is one that I think is sort of quality. It owns Hoka, which a lot of people probably wouldn't know. So again, really up and coming, challenging brand against Nike. Again, struggled. Could make a bit of a comeback if they have that catalyst, as you mentioned. Lululemon, again, struggling, but we've seen some, better performance from Nike recently. United Health, another one, dominates the US insurance market, but has obviously had a lot of, problems. Obviously the issues they had within the last sort of 12 months, but still a great dividend payer at the same time. Moderna was, a name that was a bit of a darling of the market during COVID. And then you obviously mentioned Chipotle as well. It's obviously a very successful brand over, in the US. So again, there's some quality names in there. And again, you're in the S&P 500 for a reason at the end of the day. So, those drawdowns are definitely something to look at. And, coming from, trying to find out where that catalyst is or bottoming or whatever. And again, I think a key point is not trying to be able to pick the bottom, but if you believe that there is a catalyst in place, or you do see things starting to sort of turn around a little bit, there are some sort of significant drawdowns there, right?
Yeah, absolutely. And also, I think I was just checking the website now that shows the 52-week highs and lows, and Salesforce are in there at the moment now as well. This is a company that's trading about $232. Wasn't too long ago, beginning of the year, they were up at near 375. So, bad quarters, bad headlines, the market fluctuates, doesn't it? It doesn't just go in one direction for the whole time. And I guess there'll also be people out there and United Health, right, which came under significant pressure. But people asking that question, is this now the opportunity? Is this a stock that should never be below $300 a share and actually should be, way higher than where it is? And it's had, a few days now in a row where it's just started to, push higher a little bit. 1, 2, 3, 4 green days in a row. It's back above the low that we had in May. Technically speaking, I'm not trying to call the low, but from a purely technical point of view, just looking at the chart, it wouldn't surprise me. But of course, things do need to change there and whatnot. But there are opportunities when markets get beaten down, and for a lot of people, that's kind of how they look at the market, because of the potential reward that you get. If it does recover and you do believe that it's undervalued for whatever reason. So I think it's quite interesting to highlight a few of those. And I'm sure there are some people that only trade or invest this way. Or on the flip side, Josh, there are also people that like the strategy of, okay, give me a 52-week high, break above it. The trend is trending in the right way. And that's the opportunity as well to get that next push on. Because you see a lot of the time as well, don't you? Stocks break new all-time highs and then, give you another 20, 30, 40% and more. Nvidia is a classic example of that. Palantir, a classic example of that, where they've got the momentum and they break those highs and you just get more buyers coming in. So there's more than one way to skin a cat, isn't there,
Yeah, absolutely. And I think the points you mentioned around Nvidia and Palantir and those types of names are really key as well, because Palantir has been the best performing stock on the S&P 500 this year, but it's not been without pullbacks. So and that's pretty key to sort of remember. And think about Nvidia. When Nvidia had the problems around CoreWeave and the stock sank, that was below $100 a share, or around about $100 a share, I think. It might not have fallen below $100, but it was close to. It was maybe around 100, 110. A lot of people probably sitting back now saying that was an opportunity, right?
Shoulda, coulda, woulda. Story of my trading life, I tell you.
Me and you both.
We'll wrap it there. As always, Josh, pleasure to have you on. Safe trip in Singapore. When you back to Sydney, you got a little while there or a couple of days?
Yeah, well, I'm here till Friday, so fly back on Friday back to the motherland of Sydney. So yeah.
Safe trip. Cheers, mate.